All right, I think we can get started. I'm sure some more people will join, but we've got a good turnout tonight. So thank you for everybody. Thank you for giving us your time tonight and your interest in our new deal, The Grove. My name is Gideon Pfeffer. I'm the CEO and managing partner at the GSH Group. As most of you know, we're an owner-operator sponsor of mostly multifamily apartment communities throughout the United States. Currently, we've got a portfolio of just over 6,000 units. That portfolio is located in Michigan, Indiana, Ohio, Maryland, and Florida. I'm joined tonight by a couple colleagues and friend, Amy Young, who's the director of our asset management division, Mark Benyas, who is another director with GSH, and Nathan Leader, who's also a friend and investor. We'll hear from the three of them tonight. Before I jump into the presentation, I just want to kind of give you an idea of what our plan is. And what our plan is we're going to I'm going to share with you what our new deal is, what the investment is, and the investment opportunity. I'm going to show you pictures. I'm going to talk about the financials of the deal, why we like the deal, and then you're going to hear from Mark about the location of the property, Grand Rapids, which we feel is probably the best market in Michigan. You'll hear about our due diligence process from Amy, and how asset management complements property management. And you'll hear a little bit from Nathan too. Nathan's been investing with us for years. He's also brought some of his friends and family in, and we'll have a little question and answer with Nathan about why he continues to invest with GSH. And then afterwards, while you're not on screen, there is a Q&A icon at the bottom of your screen. You can click on that and you can ask questions, type up questions, and I'll do my best to answer all of those at the end. My plan is to present for maybe about 30 to 40 minutes tops, and then spend 15 to 20 minutes on questions so we can all be done in an hour. So again, I really appreciate you joining us tonight, and let me just share my screen. So I always try to put myself in an investor's shoes because, well, I am an investor also. So what's interesting to me and what's going to catch my attention initially. So I'm going to jump right in to showing you pictures of the Grove so you can visualize the investment as opposed to just showing you slides with numbers on it first, right? So what's really intriguing about the Grove, as you can see, is that it's a new construction property. It was just built and delivered in 2022, and the property is just coming out of its lease up period. So it's been filled up, and we negotiated with the seller to not close on the property until it was 95% leased. We did that so we could maximize our loan proceeds and make sure that the property was in the right financial condition, and vet out the leases and vet out the residents before we purchased the property. Again, here are just a variety of different pictures, interior and exterior. As you can see, it's gorgeous. It's beautiful. If I lived in Grand Rapids and was a renter, this is where I'd live. It by far will be one of the nicest properties in the GSH portfolio. Once we purchase it, we plan to purchase it in, there's Mark. We plan to purchase it on March 1st. So the Grove consists of 320 units. Its current occupancy is 90%. As I said, we'll close when it's 95%. We're purchasing it for $94,800,000. We're putting a ground lease on the property. And for those of us who are not familiar with the ground lease, it's essentially like a sale leaseback of the land. So if you think of a property with land and then improvements, the improvements being the structure, the actual sticks and bricks of the property, we bifurcate those two things and we sell the land and then we lease it back to the person who buys it, or the group that buys it. It's a structure that's becoming more and more prevalent in the multifamily arena, very common in commercial and commercial retail. And what it allows us to do is to reach a debt level that's kind of normal in a abnormal debt environment at a combined interest rate that's lower than what today's debt interest rates would be. So we've been creative in terms of how we're putting that together. After the ground lease comes off the top, our purchase price is $59.8 for the improvements. On the $94 million, The average purchase price per unit is $296,000. Some of you might say, wow, that is an expensive price. That seems like a lot of money to pay per unit for an apartment complex. But we've got a lot of contacts and friends who are in the building business that we consulted when we were looking into purchasing this property and negotiating on price. And what we learned is, in today's market environment, with today's cost to build and supply chain situation, this property isn't built for better than $250,000 a door. So while the developer is making a profit like we would expect, they had originally come to market with a property looking to achieve a purchase price of $115 million or better. And they probably would have gotten that about a year ago. We were able to go in and negotiate. We actually pulled out of the negotiation, pulled out of the marketing process. The developer didn't get the price that they wanted. And then a few months later, they decided that they were willing to make a deal. And the brokerage that listed the property reached out to us because we do a lot of business with them, and suggested that we come back to the table and try and negotiate a deal. And we were able to get a deal that made sense to us. And I'm thrilled to be able to buy this brand new property for less than $300,000 a door in Grand Rapids. It's amazing. We're raising $29 million from our investors and our GSH controlled entity, and our investment in the property is more than 10% of that at $3.5 million. Closing March 1st. So let's talk about opportunity, right? Talked about it already. The opportunity is to purchase a property brand new in the best market in Michigan. We'll go into why we believe that Grand Rapids is just a phenomenal market. We're structuring this deal similar to all of our other deals with a preferred return, this time 8% and a 65-35 split to our investors after that preferred return. Now, as I'm putting my investor hat on, I'm always wondering, like, well, what, I was trying to go to the bottom line, right? What's the bottom line? What am I getting out of this deal, right? And the way that we look at this deal is that people will say, how long are you going to hold this property for? When are we going to sell this property? And, based on today's market environment, we're not sure when we're going to sell this property. And this is actually a property that I would love to own forever. And forever is a long time to fathom. But a lot of our investors are cash flow investors. They've got excess capital. They've got money to invest, and they care about the return that they're going to get. They like the cash flow. They like the income stream. And this property is going to be a great income stream for all of us. As you can see on this slide, there's a 10-year average return of just under 9.5%. What I'd like you to take a note of is that the first 5 years, while lower than 8%, the second 5 years, year 6 through 10, on average, is greater than 10%. So what we're doing is we're getting into the property, we're managing the property efficiently. The rents are below the market rate right now because it's a new lease up from a builder. We're gonna increase the rents over time to match where they should be based on the market, and then we're just going to cash flow, and we're going to cash flow into the sunset, if you will, right? So over a 20-year period, the average return on this property is and this investment is almost 20% average, right? On an annual basis. The plan here would be to refinance in about year 7, return a majority of the equity out, and then probably do another strategic refinancing a handful of years after. So ultimately, within, call it 10 to 12 years, you'll have all of your equity, if not sooner, you'll have all of your initial equity invested back, and we're all just cash flowing and owning this property until the market says it's time to sell. And for me, you can't argue with these cash on cash returns. It's super exciting to be able to see this in today's market environment on a brand new property. I think we really scored when we were able to take this property down. Well, put it under contract. So I'm excited about it, as if you couldn't tell. I'm gonna talk about the GSH group, but a lot of you know about the GSH group. So I'm gonna move quickly through this. And if anybody has any questions, I should say this regardless of how quickly or slowly I walk through this presentation. My goal for you, or my goal for us during this presentation, is to share information with you, share information about us, to share information about our process, to share information about this project and why we think it's worth investing in. A win for me would obviously a win would be to say I'm in, right? I'd like to invest, but even a more simpler win is just I'd love to learn more. I'd love to set up a time to talk to you, Gideon, to talk more about this. I'm interested, but I need to know more. That's also a win. So I think the one of the most important pieces of the GSH group is our concierge approach to investing. For those of you who are already investors, you know how much we care about communication and transparency. When things are going great, you're going to know about it. When things are not going great, you're going to know about it. But we're communicating with you often. So not only are we giving you a thorough quarterly report along with your distributions, but we're also giving you a monthly report on updates on the property, on every single property in our portfolio. You're also getting remarks from me from time to time. You're getting emails with successes that we're having. And so our philosophy is communicate as much as we can, communicate transparently. It's up to our investors and our followers to decide if they want to open up the emails or not, but we're going to send them to you. We focus on superior returns in not only in today's market environment, but in the market in general. It's sometimes can be daunting and difficult to identify and put trust in a group or individual or a group of individuals with your hard-earned dollars. And we take that very seriously. To be stewards of your hard-earned money is something that we think about every single day. And we want to work as hard as we can for our investors to make sure that they're getting superior returns and satisfied with everything that's within our control. Predictable income, an investment secured by real estate, and an investment with social impact. Our current portfolio is at about $1 billion in value. Full cycle deal means a property we purchased and then sold, or purchased and then refinanced. We purchased 39 communities together, the G, the S, and the H, myself and my partner, Hanan Shmulek. We purchased over 9,000 apartment units. 7,400 of those were under the GSH umbrella. The other ones were properties that we purchased prior to coming together as GSH. Our average cash on cash return across our portfolio has been over 10% on average, and our average tracked returns, not only on properties that we've already sold, but properties within our portfolio based on what we believe to be the current valuations, is above 24%. Over the last 10 years, we've raised quite a bit of money from investors like yourself. As you can see, between 2012 and 2017, it was pretty nominal, but we've had success through all of you and other investors in deploying a significant amount of equity. And over the last 2 years, we've deployed over $200 million of our own money and our investors' money in multifamily apartment communities, and that's not inclusive of any larger institutional type checks, hedge funds, or joint venture equity groups. We haven't taken on that capital up until this point. It's really through accredited investors like yourself. Our team is deep, and our team has significant experience. And actually, Amy, this slide was created before you came on the team. So my guess is that this operational experience in 34 states probably could be a lot higher since adding you and Lisa and Daniel. But nevertheless, the executive team has well over 100 years of combined experience on over 275 properties. We currently have over 800 happy investors. In the past, I transacted on a lot of single family, over 2,500 single family homes, and we've transacted on or been involved in some capacity over 50,000 multifamily units and over 15 million square feet of commercial space. So our team is deep and knowledgeable. Another advantage to GSH, like I mentioned earlier, the Grove went out to market in a competitive way, and the seller didn't get their number, and then it was brought back to us. Why was it brought back to us? We've got a great reputation with special servicers, with banks, with brokers, with institutional and private owners. This allows us to get access to deals that others can't. This allows us to get to the table and have meaningful conversations with reasonable sellers that others don't. We like win-win transactions, and that allows brokers to bring us back to the table time and time again because we're reasonable and we do what we say we can do. And I think that's the benefit of that the Grove, why we're sitting with the Grove right now at 20% below what the property originally went out to market for. Okay, so talking about the Grove, I'm gonna slide through some of these. So let's talk about Grand Rapids. Grand Rapids is the second largest city in Michigan. It's a fast growing metro area. The median household income within a 1 mile of the property is 106,000. I think Amy will share later something along the lines of our census of the current resident base based on our lease audit during due diligence was actually above that number. I think the average of our residents is like $108,000. So a higher earning demographic is renting from this property. The Grand Rapids market in general, from an occupancy perspective, exceeds 98%, and rents have increased over 9% over the last year, and continuously go up. This lists a delta of $280,000 between original leases and where we think we can lease the property, but we didn't put that into our pro forma. Our pro forma is more conservative than that number, but we definitely know that there's meat on the bone as the initial leases come due after 12 months. We can institute modest rental increases and continue to increase rent without really any kind of value add program, without having to do any kind of construction, which is typical to our deals. We have to wait longer to enhance and do more to enhance the bottom line. I think I've probably touched on most of these things. And as you saw through some of the pictures and some of the pictures that I'll show you, the units are beautiful. They're decorated with wood style flooring, tiled kitchen backsplash, modern lighting, smooth glass cooktop stoves, stainless steel appliances, granite countertops, walk-in closets, ceiling fans. I mean, full-size washer and dryer. 65% of the units have garages. I mean, this is just a home run of an asset, something we're thrilled to be able to bring into our portfolio. Okay. I'm going to go into the financials. And again, I'm going to go through them. And if you want to talk to me about them after this webinar, please feel free or ask any questions that might come up during this process. So as you see, I talked about it earlier, we've got an 8% preferred return. We've got our promote split of 65-35 after that 8%. Again, a preferred return means you're not necessarily getting that return in year one. What it means is that our investors, and we're investors just right alongside you with dollars, that $3.5 million that's listed. As investors, we get an 8% return before there's any profit split with GSH. Okay, so if there's profit to be made, the first 8% goes to investors. After that 8%, then 65 cents of every dollar goes to the investors. As you can see, like I mentioned with the ground lease, our capital stack pie chart shows a portion of debt, a portion of equity, and a portion of the ground lease. And for our first mortgage debt, our pro forma numbers show a $39,468,000 first mortgage. That's going to be with Freddie Mac. It's approximately 66% LTV of the price less the ground lease. It's a 10-year mortgage with a 30-year amortization, a 5-year interest only period. We haven't locked the rate yet, but we pro forma at a 5.85 interest rate, and that's what all of the returns that I showed you earlier is tied to. However, we're within days of locking the rate. Our spread above the 10-year treasury is 2.05. If we locked right at this moment, our interest rate would be 5.55 or 0.3% or 30 basis points below, more than 0.25% below what our pro forma says, which would be gravy for all of us. So we should be in a position for lock approval, probably early next week. The treasury may move a little bit higher than that, but I think we're still going to be in the money in terms of an interest rate when we do lock. So I'm excited about that as well. This is the sources and uses, and I just want to show your attention just again to the sources. So we've got senior loans, we've got investor member equity, what we're raising, the 29 million, and then the ground lease. And I already went through the returns, but I put this number back, or this slide back in, to touch on the year one cap rate with the ground lease. I think this is important to note that on the high side, our interest rate will be 5.85, and our year one cap rate, because of that ground lease, is a 6.35. So we're achieving that delta of a lower interest rate versus a cap rate. And that's the profitability factor that we were all chasing and always are chasing when it comes to buying a multifamily property. When interest rates were really low and continued to go down and stay down, cap rates followed, right? Because of competition. But we were always trying to hit a cap rate that was higher than the interest rate. And we've achieved that on this deal. And it's a fixed rate loan. Something that I will also talk about a little bit later. I'm going to touch on briefly some of the other benefits of investing in this deal and investing with GSH in general. And one of those is that we do cost segregation and accelerated depreciation. And for those of you who are not familiar with that, what that is, there's a tax benefit to owners of investment real estate where you can depreciate the asset over a 27.5-year period. Well, there's also tax legislation that allows you to accelerate that 27 years of depreciation in the first 5 years. And so what our investors find is that they can invest with us, they can get cash flow from day one, they can see an asset appreciate in value as well, and at the same time get a loss on their K1 from the investment for the first few years because of the accelerated depreciation. So it's really a great tool to take advantage of from this accelerated depreciation. I'm not going to go into much more detail, but you all have a copy. All of these slides, by the way, are part of the marketing booklet. They're all in that marketing booklet that you have access to from all of our emails that we sent. If for some reason you weren't able to access it, let me know and we'll get you a copy via email. But everything that I'm going through today is you already have access to. I'm just highlighting it on this webinar. This talks about the ground lease. I talked about it before. Any questions that you have, let us know. Now, what I'm going to do is I'm going to pass it off to Mark Benyas. Mark Benyas has been with me in the GSH for 5 years. He brings decades of real estate experience across the country with multiple asset classes, and has been an amazing, tremendous resource to me as we've grown our business and sought out profitable properties to bring to U.S. investors. Mark's going to talk about what he likes about Grand Rapids.
Hi, everybody. I really like Grand Rapids. I've been doing business there for about 25 years. It's a town with about 1.1 million people, and it has an extremely diverse group of industries there. It's also a place in one of the top 10 places for millennials to relocate in the country. The industrial clusters there consist of information and technology business, life sciences and healthcare and medical devices, advanced manufacturing and food manufacturing and distribution. There are a number of public companies that are located there. Originally, the town developed around furniture manufacturing and agriculture. And all the modern furniture that you see today internationally probably was manufactured there. You have companies like Knoll, Herman Miller, Steelcase, Hayworth, who are located in this community. You also have a huge healthcare institution called Spectrum Health, which has recently renamed itself as it merged with other major healthcare institutions across the state of Michigan. Now it's called Corewell, and a lot of advanced manufacturing of all kinds of different things, airplane parts, all kinds of stuff. Finally, in the food area, you have a lot of food processing and distribution. Major companies like Meijer, who has over 100 supercenter stores, primarily in the Midwest, is based in Grand Rapids. Gordon Foods, which is a national food company that supplies churches and religious institutions and all kinds of institutional food companies in their smaller stores. and other food distribution companies like Spartan Nash. The other thing I think about is, as I'm looking at my Merrell shoes, which are made by the same company that made Hush Puppies, that company is located there. They're called Wolverine Worldwide, and so they manufacture a number of different footwear, including Saucony and other companies that they've acquired. But what I really like about Grand Rapids is the fact that it's an affordable place to live. It's very attractive for people. It's accessible to vast recreational areas. It's clean. It has affluent areas, and the property that we're acquiring is in one of the most affluent areas of the community. It's on the East Beltline corridor, and East Beltline is a north-south street that connects the 28th Street corridor, which is one of the commercial corridors at the south end of town, to the northerly suburbs, which is a very affluent area. East Beltline is sort of a green corridor where the communities along it really restrict what you can do and what you can develop there. And you only see high quality development along there. And there's significant barriers to entry in terms of getting properties and getting them approved. I know that personally because I was involved in developing one of the first major shopping centers 2 miles south of the subject property, which was the first new Meijer store in 15 years that had been developed in that town. But that corridor has grown significantly, and we're really thrilled to have this property and be able to acquire a brand new property in this really astounding town. I look at it like a mini Indianapolis. It's a diverse economy. It has a young population. There's a lot of income. There's a lot of growth, and the economy is very diverse, and they plan well. Oh, they have over 90,000 college students living there as well. There are a number of mid-sized colleges aggregated in the town as well.
Awesome, Mark. I really appreciate that rundown.
Sure.
That was great. Okay, I'm gonna go a little bit more into the GSH group of my team, and then I'm gonna have Amy talk about our due diligence. So you know me as the G in the GSH. I've got two other partners, Shmuel Cohen and Hanan Liss. Some of you have had the opportunity to meet these gentlemen. Shmuel actually lives, we call him, his nickname is Shmulik. He lives in Israel. Hanan is obviously here from Michigan with us, originally from Israel, and goes back and forth. Very well known in the community and very philanthropic, and I'm lucky to have them as my partners. I wanted to share this slide. I'm not going to go through the slide with you, but I just wanted to show you depth. You know, we have a robust executive team, operational team, investor relations, acquisitions, finance, asset management. While we don't do our own property management, we rely on best-in-class third-party property managers to do that. We have a team of very experienced asset managers who are the ones who take over the property after it's acquired to basically see the business plan through and to make sure that we're maximizing value and implementing any kind of strategies on an ongoing basis to provide value and increase value on that property, and to manage the managers and hold them accountable and set benchmarks for production and performance. Amy Young comes with decades experience on the property management side. She worked for some name brand property management companies that you would all recognize, both in Michigan and in other states. She's been in charge of tens of thousands of multifamily apartment units. Most recently, she was the head of the property management division with hundreds of employees overseeing thousands of units. I was able to convince her to come over to the ownership side and lead our asset management team, and GSH has never been so strong under her leadership. She's going to talk about really our relationship with RPM and what we did to be thorough in the property as we evaluated the property to make sure that it was the right investment. So she'll unmute, and while she's talking, I'll scroll through some additional pictures of the property.
Thank you, Gideon. I'm super excited to be here and share some insights into our due diligence process, our property management agent partner, RPM Living, and our asset management team at GSH. I've prepared some notes that I'm going to read through as I want to be thorough and informative about the process that we implemented, especially during today's economic times. So for the Grove, we partnered with the due diligence division of RPM Living to join us in an extensive process that we completed in mid-December. We chose RPM Living as our management agent partner because they're vertically integrated, they're highly ranked, they manage over 112,000 units in 21 states. We know that their system structure and training platforms, coupled with our intensive ownership and asset management approach, is the recipe for success for not only this property, but our entire portfolio. Our asset manager team has over 80 years of collective experience in the property management field, specifically in multifamily. And with this firsthand knowledge in the day-to-day operations of large portfolios, we know what questions to ask, and we really dig deep when communicating with our agent partner. And our collaborative hands-on approach is very proactive, creative, and strategic, and it brings great solutions to each of our communities. And we keep in mind constantly our number one responsibility, which is to residents and to you as our investors. For the due diligence process specifically, we had a team of 20 members at the site during that process, and that was both GSH and RPM professionals. RPM deployed 14 representatives from various levels of their organization. It included like high-level operations team members, facilities, director of facilities, management, community managers, and leasing professionals. They were all present to walk apartments, review files, assess the physical condition of common elements as well. In addition to that, we had 8 GSH team members on site, which was inclusive of Gideon, Mark, and myself. Our process was extremely thorough, and we included a lease file review in which 100% of the files were reconciled to the rent roll. We verified rental rates, security deposits, and lease terms, and no material findings were noted in that review. We also reviewed employment demographics, resident demographics. We verified that they were screened properly and truly qualified. And we also looked at utility expense recapture to make sure that the revenue sources were valid. In that review, we were able to look at the median annual household income, and that reported out to be roughly $108,000 annually, and about 40% of the resident base is employed in the professional, executive, and medical industries. And this included occupations such as pharmacists, registered nurses, and sales professionals. We also scheduled unit inspections for 100% of the apartment homes, and the team was able to gain access to 299 of the 320 apartments, which was roughly 93%. And then we compared that review to work order history to identify any potential maintenance trends that we needed to be aware of. We also reviewed third-party inspections and ordered a few supplemental inspections as well. These would be things such as environmental reports, roofing, HVAC, plumbing, concrete, asphalt, life safety, and the garage structures. In addition to the items mentioned, the team also reviewed service contracts, capital needs. We walked and documented all of the common areas. We reviewed the property's inventory and also completed an extensive market analysis. At the end of it, the results of the due diligence were unanimous. Everyone revered this property as a premier community that's in a fantastic submarket with spacious floor plans, well-appointed amenities, a strong resident base, and a solid surrounding area demographic, which should sustain and support our investment strategy. Gideon, I'll pass back to you.
Awesome. That's a great report, Amy. Thank you so much. You know, it was important to me that you as potential investors or potential investors understand the level of scrutiny and diligence that the entire team, not just the acquisitions team, but the asset management team, property management team, puts into evaluating these assets to make sure that there aren't any surprises. Sometimes there are surprises with older properties, and that just can't be seen originally. But with a new property like this, we expect little to no surprises. Okay, so a little bit more about GSH, and then we're gonna ask some questions of Nathan, then open up some questions for you. I'd be remiss if I didn't talk about our mission and what clients we serve, right? So every day GSH focuses on two sets of clients, two very distinct and equally important sets of clients. On one hand, we've got our residents who are clients, and we strive every day to provide a safe and clean and affordably priced place where people can call their home. And on the other hand, our investor partners are our clients, and we strive to provide a safe and a transparent and risk-adjusted way for our investors to achieve a superior return. So from myself, my partners, our executive level team, all the way down throughout our team and property management, that's what we're always focused on, is the end result. Are people happy to live where they live? Do they feel respected and seen? And do our investors feel that we are doing everything that we can within our control to be good stewards of their investment? And we take that very seriously. This is the last slide in the presentation, so I'm going to actually ask Nathan Leader to unmute himself. And I mentioned earlier, Nathan Leader has become a good friend, and his first investment with us was back in 2017. I think the third deal that GSH ever did together. He didn't just jump in. I think that we showed him our second deal, and he took a pass, and then he jumped in on the third one, and has been investing consistently, pretty much consistently ever since, and also has chosen to bring in some of his friends and family. And Nathan, I wanted other investors to hear it from an investor themselves, and tell everybody a little bit about your background and what it is about GSH that got you to invest and continue to invest.
Okay, thank you, Gideon. Thank you for allowing me to speak. I'm not really a part of the GSH family, but I am part of their group as far as a rather large investor. I'm a third generation real estate professional. My grandfather started in real estate back in the 30s and 40s. My father was in it, and now I'm in it. And I've been involved primarily in the multifamily sector. It's the darling of the real estate world, in our opinion, and everyone always needs a place to live and a roof over their head. So I really look for good quality investments, and not only do I look for good quality property and investments, but I look for the right partner to be with. You could have a property that's in an A+ location and a manager or a person who's in control not really knowing what they're doing. You're not going to do well, even though you're in a good location. I don't feel that's the case with GSH and all the players that Gideon has under his wing. They are great operators. They're great people. They know what to do in good times and bad times. And that's the hardest thing to find when you're investing in real estate, is the right partner. I met Gideon back in late 16, early 17, and looked at his first deal, which was in Fort Wayne, Indiana. And I said to him, I wouldn't touch it with a 10-foot pole. No way. I'm walking away. Well, he showed me wrong. Years later, he ended up selling the property for a nice profit and did well. So I guess I missed out on that one. But lesson be learned. We moved on to the next deals, and we did well. We liked what he had. He showed us he's capable of doing what he promises he can do, what he thinks he can do. And after I invested with my partner and I in the first few deals with him, just us, we started to bring in people who invest with me on our deals. And I think, Gideon, out of the $300 million of equity that you've raised, I think we've raised upwards of $50 million towards that total stack. And we have a large contingency of investors that follow us, that go with us. And Gideon's not our only jockey that we ride. We have others that we deal with, but we have a lot of money invested with Gideon. He's proven to us he knows what he's doing. He's built a great team, and we're very pleased. Now, I know you didn't ask me to talk about the property in Grand Rapids, but I just want to make one comment about it. And I'm very familiar with Grand Rapids. I had a mobile home park in Grand Rapids some 35, 40 years ago. So I know Grand Rapids for a long, long time. And they say that the three most important things in real estate are location, location, location. They are, but like I said, so is the partner you're partnering with. But in this particular case, this Grand Rapids property hits it on the location. It is a tremendous community. It's in the right location. It's a beautiful property. And I typically have a number that I usually invest personally. I'm doing more just because I really feel that this location and this property is I don't want to call it a home run, but it's just quality. It's just quality all through and through. I don't know. What else do you want me to talk about, Gideon?
I think you're fine. I mean, I'll open it up to, we're going to open it up to a Q&A now. And so if anybody has a question that relates to something or Nathan's experience, I'm going to try and get to all of those questions. And so maybe we'll bring you back, Nathan, if somebody wants to ask a question. I appreciate your words and your partnership. Nathan and his partner syndicate and bring their investors into our deals and most of our deals. And we've had a good relationship together. And I think something that you made me think of, and a question I want to address right up in front is that, actually, let me open up the question so I can make sure that I'm dedicating.
Before you open the questions, Gideon, I just want to make one last comment.
Please.
I've invested, or we've helped raise money for 19 of your deals. So I wouldn't be doing this if we didn't believe that you're the guy, or you're a guy to invest with. So I just wanted to leave with that.
Thank you. Thank you. And the truth is that we GSH doesn't have a business if we don't have satisfied investors. Does every deal always go as planned? No. Are there external forces like rising interest rates or rising costs, expenses, utilities, payroll, things that were created because of the inflationary period that are affecting certain business plans? Yes. Are we happy about it? No. But what we continue to do is be transparent. What we continue to do is talking. 70% of our portfolio is in fixed rate debt, is completely stabilized. 25% was purchased with floating rate bridge debt, and we're working through it and being very communicative with the investors in those deals, in some of the market-based challenges that they're having. What I love about this deal is that we don't have to deal with stuff like that. We were able to underwrite higher costs because we've now been through 2021 and 2022, and we understand what the new normal is for utilities and insurance and payroll. We are getting into fixed rate debt, right? So our interest rate is fixed. One of the questions has to do with the specific terms of the ground lease and the specific terms of the permanent loan. And so, I'll start with the permanent loan. Again, the interest rate is fixed for 10 years. For the first 5 years, it's interest only payments. For the second 5 years, it's principal and interest fully amortized on a 30-year amortization. The interest rate is not locked yet, but we put in our financial modeling an interest rate of 5.85%. We believe that we will be less than 5.85% by the time we lock, based on where the 10-year treasury is today, which is directly related to where our interest rate will be. Essentially, our interest rate is the 10-year treasury at the time of the lock plus 2.05%. Right now, the 10-year treasury sits around 3.5. So if we locked right now, it would be 5.55 or 30 basis points below what our pro forma interest rate is. The ground lease starts at an interest rate, an interest payment of 5.15. It increases. It's got a unique way that the payment increases over the first 10 years. It's essentially 2.5% each year, not 2.5% on top of the 5.15, just 2.5% on the payment. So the payment escalates by 2.5% to basically stay in line with inflation over the life of the ground lease. I did negotiate the first 5 years has a lower increase than 2.5. It's more like 1.75. And then the second 5 years has a little bit of a higher rate than 2.5. And then years 10 and on are 2.5%. I did that because our rate of return in the first 5 years is a little bit lower, like I mentioned. So I wanted to maximize free cash flow, and I was able to negotiate that. The ground lease the ground is being purchased by a completely third party. They're not associated with the lender. They're not associated with GSH or anybody on this call. They're a family office, a very wealthy family, a real estate family that is institutionalized and uses ground lease purchases as a strategy for their overall investment portfolio. They do this all the time. They deploy $200 to $300 million a year in ground leases, and we've developed a really great relationship with them. We expect to do more business with them in this type of structure. This won't be the new structure that we're doing, but for certain circumstances on deals that we really believe in and believe that we want to own for a long time, that would be the case. Somebody asked a great question about a long-term investment, right? They asked a 20-year investment horizon is a long time. And again, look, I'm modeling out what 20 years look like. The market might be such in 10 years that it makes sense to sell the property, right? And we may, but GSH is building a portfolio. We care more about long-term cash than short-term income. Our strategy is let's all invest together. Myself, my partners, my team, and our investors, and let's return capital through strategic financing, refinances, supplemental loans. So our initial investments are taken out, and then we just own the property free and clear and cash flow free from that point on. So the question centered around a beneficiary question, which is, is there a way to transfer ownership upon death or will the property transfer to beneficiaries? And the unequivocal answer is yes. Okay. The asset, the investment in the syndication in the LLC will be a part of your overall estate plan, and you'll just need to tie it into your overall estate plan, your will, your trust, however you're set up, just like any other asset or security, and it'll automatically transfer to any beneficiaries in that circumstance. Here's another question. When you review the financial considerations, please help me better understand the proposed debt structure, terms of debt, expected rate, and any risk of rate increase. I think I just did that along with the land lease, but if there are further questions, please type them in. Can the loan be prepaid without penalty? So the answer is the loan can be prepaid, but there is a significant prepayment penalty, and we don't expect to prepay the loan, nor do we expect to have to prepay the loan in that 10-year term. The prepayment penalty starts high and goes down over time. We have sold properties as well as refinanced properties out of debt and paid prepayment penalties when the market was really hot, where it made sense. Those prepayment penalties that we paid in the course of a sale or refinance show as an expense and a loss on the balance sheet, which benefits overall income earned if we do pay that, if it makes sense to pay it. Another question about the ground lease, how it factors into the financials, so that there's a payment to the ground lease holder that just is a line item in our expense section. So we've got revenues, expenses, and it's just a line item in the expenses. And our senior loan is tied to, our debt service coverage ratios that determine the amount we can borrow, factor in those payments from the ground lease. And so we're borrowing at a level that the lender is comfortable based on the payments that we're going to make on the ground lease, and all of the net cash and returns that you're seeing are all net of both of those payments, both ground lease and debt service. I see David asking for the presentation. I'll definitely send that to you, David. Are there any major rehabilitation costs built into the projections of the property, excuse me, as it gets older? So we are budgeting a $3 million reserve. I like sitting on cash at properties. We don't have any direct significant rehabilitation plans for that property. It doesn't need anything. We might add some low dollar, relatively speaking, low dollar things like EV charging stations, because we believe that this demographic of resident will be driving electric vehicles and there aren't any on site. I believe that for A-class properties, every 5 to 7 years, it's time for a refresher, new cabinets, new countertops, paint, carpet. So that extra cash that we're holding on to will help, but we probably won't even, be necessary based on cash flows and organic turnover of residents where we just freshen them up. But I guess the simple answer is no. There are no major rehabilitation costs built into this. What one-time ongoing fees does GSH charge? So GSH charges a one-time acquisition fee of 2% of the purchase price, which is standard on all of our properties. We also charge a 2% asset management fee. That's not on the equity raised, which is often what an asset management fee is charged on. Like a fund structure, it's actually tied to the effective gross income at the property. So our fee is tied to the success and revenue of that property, and that's market for the industry. As a potential longer term play, is there a desire to reacquire the land? If so, what would be the scenario where reacquiring the land would be desired? So the way that the ground lease works is that more than likely we're not going to reacquire the land. There's not a mechanism where we can just pull the trigger and purchase the land, but there is a right of first refusal with the ground lease holder, which means that if at any point that they choose to sell the land, they need to offer that land to us first. What would happen is if we want to sell the property, the land lease, it wouldn't be an encumberment. The new purchaser would come in and assume that land lease, which means that they'd have to raise less equity and be in a similar structure to us. And the profit on the property would be proportional to our equity and our current loan amount. So it's a unique vehicle that might be new to some of us, but the truth is that it's not a detractor from the overall deal or a potential sale if we wanted to. We go into more detail about loan rates, fixed or variable. It's a fixed rate loan, and I think I've gone through them a few times. So I think we're there again. Fixed rate loan, fixed for 10 years. After 10 years, there's no payment penalty. Modeled at 5.85%. We expect that rate to be lower by the time we lock. Are there any other capital expenditures we plan on doing that will increase NOI? That's a question that maybe, I don't know, Amy, if that's something that maybe you might bring in. I don't necessarily know if it around the context of spending more money to raise NOI, but some of the other things that we do around any property to enhance NOI.
Yeah, we don't have anything right now planned specifically, but we do constantly look for like revenue share opportunities for the properties in our portfolio. If new avenues come available in the industry, we're constantly evaluating them with our management agent partner to look for opportunities to increase, even if it's just slightly. So if we see something that we're charging an extra $10 or $15 per month for, we will try to push it to 19, those small incremental increases can mean a lot to the bottom line, and they're usually absorbable by the resident profile. So we look at that monthly when we do our financial review to measure and track the ancillary income for each of our assets.
Thanks, Amy. There's a question out there about what if we don't reach the 95% by March 1st? At the moment, it's 90% occupied and it's like 94.8% leased. So we pretty much already reached that 95% at this point. They just haven't all moved in yet. So we're hitting the 95% occupancy was tied to a gross collection amount that we wanted to hit to maximize our first mortgage. Because mortgages are tied to income at a property, and we've already achieved that. So we negotiated that 95% months and months ago when they were only in the 80s, but we've already achieved there. So we're in the clear on that front. There's a question about you mentioned something about the history of the property pricing. What was the price? What was the property priced at prior to the acquisition? So it was priced at 115 million, looking for more, and we ended up negotiating over time to below 95 million, and that's where that 20% discount is coming from. Another question about the ground lease. I'm glad people are asking questions about the ground lease because it's not something that everybody is totally familiar with, and I want to make sure that everybody gets comfortable with it. Who's the owner of the ground lease? Is it our entity or a different entity? So we don't own the ground lease. We are the leasee. So we sell the land to a third party, and then they lease the land to us for 99 years, and we pay them a triple net lease. It's kind of like a sale lease back that like a company might do to a private equity firm. Going in cap rate is something that I'm not overly focused on because the property taxes haven't adjusted, and the lease up period over the last, because it's been in lease up over the last 12 months, income started at 0 and then started going up like this. So it's a hard number to quantify, in terms of what a cap rate is. But what we're modeling our year one cap rate to be is 6.35. Can I talk about a worst case scenario in terms of the economy, how a recession might affect this property? Look, I think that my opinion is that we've been in a recession for 6 months. I don't know what anybody else thinks. So the metrics have been there for many, many quarters of what a technical recession is. This is just one of the first times that I remember experiencing caveats around a recession. So I've definitely felt the downturn. I've seen tech jobs being laid off for months. I've seen costs go up. I've seen rental increases plateau nationwide. What's great about this property is that we're not doing a value add to achieve a certain rental amount. We see a delta between where it's currently rented and where we can rent it, but we've only modeled in a small fraction of that amount. So we feel really good about our numbers. And if there was a deeper recession than anyone is talking about, what's the worst case scenario? It's going to affect the amount of money that we charge in rent. It might affect our occupancy, and our overall returns for the first few years during that recessionary period will go down, which is true for really any investment that anyone gets into, right? The benefit of getting into real estate is that you get the tax benefits up front, with the reduction in income of your K1s and maybe even a loss. Definitely a loss in year 1, probably 2 and 3. And you get into an asset that's going to appreciate in value while also paying you cash flow. All right. What's the difference in asset management? I just want to be mindful of time. I see that it's actually a little after 7. I didn't realize. I apologize. Let me read some of the minimum investment amount is $50,000. Okay. The lease is paid on an annual basis, monthly, actually, just like a mortgage. The acquisition of the property, how it will play into with property taxes, will they go up? We always model out property taxes to go up. We use a national property tax consultant that gives us a best case scenario, a probable scenario, and a worst case scenario. We always take the probable scenario and the tax. We have modeled the taxes to increase to that probable scenario in our model. We've modeled the property taxes to go up more than $400,000 in year one. So we've already taken that into account. I think I've answered the question about what happens if the property is sold. If anybody has questions about the ground lease, I'd encourage you again. I'm gonna share my screen again, which has my email address on it. I think you can see it now. I'd encourage you to reach out to myself or Matan. Let's have a greater conversation. I want to get you comfortable with it. If you're not, if you think of it as just an alternative debt source, and if I was coming to you and said I had a first mortgage at 75%, and then but I've split it up into two different components, so I could have a more consistent and lower interest rate over the course of the ownership. Like that's not exactly what it is, but that's the theory behind the ground lease and why we're doing it. We do have other properties in Grand Rapids. They've performed great. The most recent acquisition in Grand Rapids was in 2020. It's actually 15 minutes down the road from this property, and it's been one of our best performers of our portfolio. Yes, everybody gets the same deal, whether you're anyone, Nathan or anybody else. Nobody gets a premium. All right. Can we use 1031 proceeds and invest in this deal? Unfortunately, no. You cannot use 1031 proceeds to invest in this particular deal. I appreciate it. There's so many questions on here. I want to answer them all. I'm going to keep answering them, but I also want to give folks permission that if it's getting late and you need to drop off, that's fine. That includes my panelists. I appreciate you taking the time, or if you want to go off screen, that's okay too. I'm gonna stay here and answer a couple more questions. I really like Mark's sweaters. Can I invest in one of those? Oh, I really like my and Mark's sweaters. You send me an email and we'll send you one of our GSH sweaters. We'd be happy to. All right. Is the state done with COVID renter protection policies? That's a larger conversation, Steve, that I'd be happy to have with you at another time. The 8% preferred return is paid quarterly. The distributions are paid quarterly. Again, the preferred return is based on a net return that you'll get before the sponsor gets any promote or success fees. And that 8%, I think we're modeling out year one is going to be like a 5 or a 6. The difference between that and an 8 will be cumulative and will be paid back as free cash flow becomes greater than 8 first before there's any kind of profit split. With my tax projection is that my pro forma for tax at 90% of purchase price or lower than that. Follow up with me on that question. I'll share with you our tax report from our tax consultant. How will other properties that GSH owns in Grand Rapids affect this property? So the other properties that we own in Grand Rapids are not of this vintage. We currently own one other asset in Grand Rapids. It's 174 units built in the late 70s, early 80s. It's more of a B class property performing quite well, but it's not in competition with this property. There wouldn't be any kind of conflict of interest between the properties and the residents, just a different demographic. Can you use self-directed 401k or self-directed IRA to invest in this? Yes, you can use self-directed funds to invest in this. We do that. and work well with your third-party servicers. Why can't we use 1031 proceeds? Good question. When you invest in a 1031, when you invest 1031 monies into a real estate project, it has to be structured differently. It has to be structured as a TIC, which is a tenant in common. We've done that on 2 of our properties. We did that about a year ago for substantial investors who are bringing millions of dollars into the deal. If that's something that's on the table, we'll do, but it's very complicated and costly and needs lender approval. And so we can't accommodate that for smaller investments, unfortunately. But if it's a larger conversation, I would definitely entertain it. Okay, David wants one of those sweaters also. Okay, no problem, David. If you all send, anybody wants a sweater, send me an email. You don't even have to invest in the deal, and I'll send you one. Okay. I think I answered all the questions at this point. If I missed you, I apologize. Send me an email, or if you're working with one of our folks, who introduced you to us, send them an email. I'd be happy. I would welcome a greater conversation about this deal, about GSH. I'd welcome conversation about the market in general. One of the things I love most about my job is creating meaningful relationships with our investors, with our investor community, with our service provider community, with my team. I'm very much relationship oriented, so I'm always happy to get on the phone and chat with you. All of our investors have my cell phone. It's on my cards and my email signature, and I try to be very accessible. So I want to thank you. Thank you for staying on later than this was scheduled for. Thank you for your time and consideration of the deal. As you can tell, we're very excited about it. I'm very excited about the fixed rate interest rate. I'm excited the fact that this is a brand new property, and I'm excited that it's in the best market in Michigan. For me, we've kind of ticked all the boxes. We haven't purchased a property since June. We've been very choosy. We've been watching the market fluctuate. We've been seeing the uncertainty in the market, and we said to ourselves, we're only going to buy if a deal completely makes sense, and this deal makes sense. I can't guarantee how many deals we're going to buy in 2023, but if I can buy more deals like this, I will. So having said that, I hope you all have a great night. I appreciate your time. Thank you and good night.